Hi, everybody. This is our update for November 12, episode 315, the day after Veterans Day, where we honour Americans, veterans, for their patriotism, love of the country, of course, and their willingness to serve and sacrifice for the common good. I'm Dean Croak, market analyst here at DAT, along with co-host Chad Kennedy, and Todd Amon joins us from Denver from ATBS. Good to have you back, Todd.
Hey, Dean, it's really good to be back. I always enjoy your show, and it's my first time on with Chad, so I look forward to the grilling from Chad as well.
Yeah, you two both have a very similar background. I was telling Chad earlier today, you both come from a fleet background.
Yeah, diesel's in our blood, man.
Yeah, that's right.
Yeah, same here. We've probably got a few years of experience between us.
Right on.
Yeah. Todd, for those new to the show that haven't met you before, tell us a little about ATBS and what you do out there.
Yeah, you bet. Dean, we are based in Golden, Colorado. We work exclusively with independent truckers and small fleet owners to help them do their books and taxes, essentially be their back office. And so we get a glimpse into kind of how their operations are running. And the funnest thing we do is we use our data and information to just help them continually improve their operations and make more money. And we ultimately do tax returns for them. We work with about 20,000 independent contractors a year. So we just have a really awesome glimpse into how the small carrier is doing on a daily, weekly, monthly, annual basis. And it's been a tough time, right, for a few years for them, but bright things are around the corner.
Yeah, I think so. It'd be good to dive into that, especially after last weekend's election result. I know a lot of carriers or a lot of drivers' mental health has improved dramatically since the election, which is good.
It's true.
They weren't a happy bunch up until last Tuesday. So I was at a truck show on Saturday where they were pretty optimistic about the road ahead, which is good news.
Yeah.
We'll bring you back in a little bit later, Todd. We'll quickly whip through the market update as we normally do, and then we'll get into our question of the week and dive into some of the data that you're seeing. So let's start off with some of the key trends we're watching. Of course, spot rates, as you all know, have been gradually increasing since the start of October, up again last week. There's some renewed strength in the market, I think, as capacity continues to rebalance. The Journal of Commerce Truckload Carrier Index came out last week. It represents the average number of trucks on the road in the large public carriers. The number of carriers at the end of Q3 flattened out. That's significant. They had been dropping for about 9 quarters, and that supports what Chad will share with contract rates at the back end of this report. Of course, port strikes. We've got Trump tariffs on the horizon, possibly. We've got port strikes in British Columbia and on the East Coast in the Port of Montreal. Workers, about 1,200 longshore workers were locked out last night. That brings a halt to traffic at the second largest port in Canada. It impacts about 10,000 workers in the entire logistics sector, though. So that disruption's been going on for about a week. The same has been happening on the West Coast in the ports of Vancouver and Prince Rupert. The BC Maritime Employers Association locked out workers last week. Mediation talks broke off last night, zero progress. Not huge ports in terms of national volumes. They both represent probably, if you take into account Prince Rupert and British Columbia, about 5% of national volumes. But very importantly, about 4 trains a day run off the dock in Prince Rupert to Chicago. So it will impact East Coast port volumes at some point if this continues on. The other data came out last week from ACT Research, new truck orders after starting a strong opening of the order books for next year last month. They took a step back in October. They were about 5.2% down from last year. So we're watching that number, very important. Not unexpected, though, according to Tim Denoyer. Imports out today, preliminary numbers, they'll be ratified a little bit later this week. But imports indicated that the peak season had passed, as we reported last month. We've had 2 months of successive declines. October containerized imports down 4% and month over month and 6% year over year. Of course, the front loading of imports already this year has been due to shippers avoiding peak season surcharges, potential disruption associated with what looks like an inevitable strike on January 15. Of course, Trump tariffs of 60% on Chinese imports and 10% elsewhere. And of course, the ongoing Red Sea Houthi rebel crisis has pushed volumes up substantially in recent months. So we expect a pretty frantic period between now and Inauguration Day as shippers look to bring in more import volumes ahead of tariffs that could be impacted. And of course, in this week's market update that'll be out tonight at dat.com/market update, we're looking at declining French fry sales and restaurant chain bankruptcies impacting reefer carriers. The cash shipment index, of course, the US capital tree is on its way from Alaska. You can track that online. And then the latest on the ISM PMI that came out last week. All right, so let's dive into the market update. Having a look at load to truck ratio for dry van, volumes declined about 10% last week, much the same as the last year in the first shipping week of November, so no real surprise in the decrease. Volumes are about 14% higher, though, than this time last year. Carrier capacity decreased again last week, down 6%. Load to truck ratio down slightly to 4.03. The USDA reported an 8% lower volume of produce nationally last week. That impacted the spot market for refrigerated carriers. Load post volumes were about 4% lower. Load to truck ratio stands at about 6.61. That's up substantially compared to this time last year. And in flatbed, national load postings fell by about 5% and down by about 11% in the last month. Loads moved in the southeast were down about 8% last week, 9% in Lakeland, Florida, after being up 53% in the last month. So we're seeing the market stabilize nationally, and also driven by the stabilization of the market in the southeast, where those two big hurricanes, Milton and Helene, made impact last month. Load to truck ratio down slightly to 13.08. Having a look at our year-over-year look at spot rates, the volume of loads moved was down about 3% last week, but capacity tightened. Last week's dry van rates are up a penny per mile at about $1.67, excluding fuel. Line haul rates are holding around 11 cents a mile higher than last year, and they've noticeably gained about 4 cents a mile since the ILA strike and the both hurricanes that hit. Up until that point, spot rates had been tracking almost identically with last year, but since the start of October, they've made a noticeable diversion. Having a look at refrigerated, the surge in reefer spot rates ahead of Thanksgiving started last week. Loads moved were up 2% nationally. Line haul rates are up a penny per mile, paying carriers an average of $2.03. That's about 9 cents a mile higher than last year. Line haul rates are around 5 cents a mile higher than the 3-month trailing average. So again, we'll see more rate movement in the next couple of weeks, but then start to decline once we get to Cyber Monday. Having a look at flatbed, line haul rates were up 2 cents a mile last week to a national average of $1.99. That's despite a 12% decrease in the volume of loads moved. Definite tightening of capacity there for flatbed carriers. Spot rates are about 12 cents a mile higher than they were last year, and identical to the 3-month trailing average, coincidentally also identical to where they were in 2017, when that year's spot market started to gain momentum leading into 2018. All right, let's have a look at the short-term forecast. These are our short-term forecasts out 35 days. The new format shows some different colors. Ratecast is our flagship product. That's in green. That's predicting what rate view will be 35 days out, and more heavily weights longer-term seasonal trends. The forecast is bounded by the upper and lower forward-looking error bands in gold and red, as you can see there. And of course, the blue is the rolling 7-day weighted moving average of historical rates for loads moved. These are loads moved over 550 miles, so line haul only, excluding fuel, and really long haul only. So let's start with dry van. A lot of seasonality here. It shouldn't be any surprise to anybody. Ratecast is looking for rates to be up 9 cents a mile out to the 14th of December. The low case scenario has still rates up 4 cents a mile. Best case scenario rates up 14 cents a mile. I had a look at last year. Over the same time frame, last year spot rates went up 10 cents a mile precisely. This year Ratecast is forecasting 9 cents a mile. So very strong seasonality there as we get into the busier part of the dry van season. Reefer rates behaving seasonally as we'd expect. We're looking for a 6 cent per mile decrease towards the end of the forecast. Last year, reefer rates rose 5 cents to Cyber Monday before they started to cool off. So again, we're seeing much the same sort of market behavior. Rates do increase substantially right up to Thanksgiving because of the combination of Christmas tree shipping, turkeys, hams, etc., along with fall produce. On the best case scenario, we're looking at rates up 2 cents a mile in refrigerated. Low case scenario has got them down 8 cents. But I think Ratecast looking for rates to rise up until Thanksgiving and then cool is pretty much exactly how it'll happen as it did last year. And in flatbed, Ratecast is looking for an increase of 2 cents a mile. Flatbed rates have been dropping fairly considerably since July 4. They do that pretty much every year. So we're looking for a 2 cent per mile lift to 12.14. Last year, rates actually rose 3 cents a mile over the same time frame, so much the same rate forecast as last year. Strong seasonality definitely has emerged in the market. So that's the spot market. Let's go to Chad to talk about what he's seeing in the contract market.
Yep, thanks, Dean. So I usually like to point out that everything Dean covered was from the broker to carrier spot rate perspective. So I'll cover everything from the shipper perspective here. And this first graph covers dry van, 3 different metrics that we track. The first one, going all the way back to 2016, is the spot premium ratio. This is the difference, the percentage difference between spot rates and contract rates that shippers are paying. So we're still at that negative 10.5% moving into November. So those spot rates still lower than contract rates. And I'll share another graph here at the end of my session here that shows the raw values here, and you can see those relationships. But we do see spot rates increasing, but relative to the contract rates, still 10% below. New rate differential, this measures the percentage difference between new contract rates and those rates that they replaced. So this is about 10-15% of our total volume that shippers are bidding out, and these are the results of their RFPs. So I love this graph because this blue graph represents the results shippers are getting from their RFPs right now. And you see the last several weeks we're kind of bumping up above 0%. So shippers are starting to take some rate increases in their long-term rate contracts. So this is a positive sign for carriers, a warning sign for shippers. And this is in line with the feedback that we're hearing back from shippers. The contract rate index there in purple at the bottom, this is a relative metric measuring contract rates over time. So you see that very flat long trough that we've been in for quite some time. So let's go on to reefer on the next slide. Reefer rates, you see that spot premium ratio is starting to climb. It's still negative 5.5%, but we're starting to see some of that seasonal effect in there. And that new rate differential in the middle in blue is not quite as positive as dry van. And the contract rate still slightly down with no real sign of increasing quite yet. That contract rate, by the way, is about 80% of the volume that shippers are shipping. There's a lot of recurring lanes in there, a lot of drop trailer mix in that as well. And then on to flatbed. So flatbed, highly variable, as you'd expect, a lot of seasonality. More depressed than the other rates from a spot premium ratio perspective. No trends up yet. And the new rate differential still quite low at negative almost 6%. And then finally, this last slide here just shows each of the 3 equipment types that we just covered: dry van, temp control or reefer, and flatbed at the bottom there. So you can see that relationship between the spot rate and the contract rate from a rate per mile perspective. This is everything over 250 miles.
Did he freeze? I think he froze. All right.
As we hit into the Thanksgiving season. So that's a wrap on the contract rates from shippers.
Thank you. All right. So definite sense the contract rate is starting to bottom out, certainly
Yep.
at the bottom of this trough, which is good news. That kind of confirms what we were hearing at a couple of shipper events recently.
Yep.
So Todd, let's bring you back in. Sort of an easy question to start with. We've got a lot of questions about what the market looks like based on the election result last week. I'm sure you've got some good feedback there. One of the questions I'm sort of more concerned about, we're seeing a lot more seasonality in the market this quarter, which is, again, what we'd normally expect. But I'm more worried about what next quarter looks like in the first quarter. So how do you see small carriers handling the soft market outlook for the first quarter of next year?
You know, Dean, I guess maybe the good news for all of us is we're getting back into some normalcy in trucking because COVID just turned everything upside down. And so seeing, good volumes, better than expected volumes in third quarter and early fourth quarter is a good thing. Unfortunately, that typically does lead to a slower first quarter. But, even before COVID, we started to see the first quarter change a bit. And a lot of it is just got to do with e-commerce, right? People buy a whole bunch of stuff for the holidays and then they don't like it and they ship it back. And reverse transportation, all those kinds of things. So I do believe, because it always happens, January is for sure slow. February picks up a bit, and then March is good. So what we tell our clients is try to plan downtime. If I got major maintenance, if I've, if I'm taking time off, like work through the holidays if you can. Don't take 2 weeks out of Christmas, take 2 days off at Christmas, and then get back to work and take your time off, those kinds of things. So yeah, miles will go down, I guess, typically for a lot of people in January, which kind of offsets lower demand. So like we've been in for almost 3 years, you just have to manage your business. You got to take the loads that are available. You got to think about the cost side. And I think the people that have survived to this point are survivors. So they'll find a way to continue to do that in the first quarter.
Yeah, that's a good observation. I've been saying that if you're still standing in this market after weathering $5.80 a gallon, 2 summers ago, middle of 2022, I think it was, you're in pretty good shape for this next market upturn. It's interesting, Todd. I just looked at the October import numbers. October import numbers are about 2.6 or 5-6 million thereabouts, give or take 10,000 TEU. But it's identical. October is identical to October of 2020, which is really interesting because that was the highest number of containers imported during the pandemic in that year of 2020. So we pulled forward a lot more volume, and I think what carriers need to be aware of is that we're actually pulling forward more of Q1's volume ahead of, I think, both the possibility of a January 15 strike and tariffs on Inauguration Day, which could be an executive order that could come into effect immediately. So I think regional carriers involved in import container moves, dray carriers, should be looking for a fair bit of activity leading up to the middle of January. That strike seems to be inevitable. So that's some tailwinds there for carriers to keep an eye on.
Yeah, that's super interesting, Dean. There's so much noise post-election, which is great, and you try to figure out what does that actually mean. And tariffs is such a big word, right? Like it's hard for a lot of people to actually get their head around tariffs. And for me, I had a perfect example conversation over the weekend with some friends. We were hunting, and in Colorado last week, we passed a 6.5% increase in ammo and gun sales to try and discourage that in the state of Colorado. And so all my hunting friends said, hey, load up, like you might need 3 to 5 years worth of ammo and, go buy that because it goes in April 1st. That's a tariff, right? At the end of the day, that means things are going to cost more. So people are going to kind of hoard that product. And your data just proves that's already going on. And likely it's going to get bigger over the next few months, not smaller. That's good for trucking, at least for the short term. We need a little bit of spurn to turn the market around.
We saw it in 2018, if you remember. I think it was May when President Trump announced the tariffs on Chinese imports that would come into effect on January 2019. And we saw a lot more volume come through in late 2018. And then, of course, we paid for that in 2019 with a much softer freight market. So I think that's something that everyone should be watching for, is that pulling forward imports to avoid certain regulatory events doesn't necessarily mean there's more demand behind that longer term.
Yeah, it's short term and long term, right? We got to think about, that helps us in the short term. What's going to help us in the long term?
I know Chad's got some questions, but your latest benchmarking report that we had showed carriers are running more miles this year. I think revenue was down slightly, but miles were up. Was that pretty much the net of it?
Yeah, it is. When I'm making less money, I got to work harder. That's kind of the way e-commerce works in the world. And so we've seen our clients, they bottomed out during COVID, running about 85,000 miles a year. They're annualizing about 93,000 miles a year, so up 7%-ish. And, there's been a lot of conversation lately. I really do think that's one of the reasons that our recovery has not been quicker, because not only owner-operators, but every truck company drivers are working harder. We're adding thousands of miles back into the 3 million trucks that are out there. And so, we still have a ways to go. Pre-COVID, drivers were running 108,000 miles a year, and we're at 93,000. So if things continue to be tough, I think drivers, they can run another 5, even 10,000 miles a year. And we're seeing that trend slow a little bit. It's, last year was a big increase. I'm expecting this year will be about half of the increase that it was last year, but that'll continue until people start making more money.
It's one of the things that gets overlooked, right? Is the more miles means that it's having an impact on capacity. It's adding capacity into the market, which has this effect of flattening out spot rates. So you don't see the normal movement in spot rates. One of the things everyone's been talking about all year is how long this bottom of the cycle has been, and that's one of the factors that you raise is the extra mileage that's added in.
Yeah, no doubt, for sure. It's brought back. It's not selling trucks and adding drivers, but it's brought back capacity that disappeared. Miles went down 20% during COVID because people were making a bunch of money, right? So it's like we just cut out close to 600,000 trucks. Now we're just bringing those trucks back.
Yeah, great point.
That's interesting. Hey, Todd, can we shift to the cost side of things? And as we do that, can you tell us a little bit about the demographics of your customers that you work with, and what are you seeing with those customers as far as cost pressures that they're experiencing? Where are they the most focused to try to reduce cost and most challenged? What costs are they facing that are hurting them the most?
Yeah, Chad. So our customers make up a wide demographic. A good percentage of them will be leased on to a motor carrier. We call those hired gun drivers. They work with the motor carrier under their authority, but we also have 25-30% of our drivers that have their own authority, one truck, one driver, or maybe 5 to 8 trucks. We call them Lone Rangers just for, if I use those names, you'll know what I'm talking about. So absolutely, they have seen their costs go up just like everybody else in the world, and especially in trucking. It took a little while for the truck inflation to hit our clients, I think, because they delayed buying those really expensive trucks during COVID, but at a certain point they didn't have a choice. So we've seen truck payments go from $2,400 a month up to near $3,000 a month over the last 18 months. Fuel prices, as Dean they mentioned, they spiked crazy. In 2022, fortunately, they've moderated and come down. Insurance has gone up. So like everybody, I mean, the costs are up 15 to 20% from pre-COVID. And so we just can't go lower than the rates we've seen for literally the last 12 months. We just can't operate without going broke less than that. Maintenance costs, we saw a dip in maintenance costs, but that was mostly people were deferring maintenance because of not making enough money. We saw those costs spike end of last year, earlier this year, as people kind of caught up. You can't defer maintenance like you used to be able to on these modern trucks, right? If you don't fix things, electronics go out and they cost you a fortune, or you get put out of service. So yeah, generally, like everybody, costs are up a lot for our customers. The counter to that is a small trucker, an individual trucker. They can manage that better than a really big fleet, right? I can manage my fuel costs every single day if I'm incentivized to do that as a small business owner. To do that in a really huge fleet with a lot of company drivers is much more challenging. So I think that's why they've had a lot more staying power. They've reacted, they've worked harder, and they've cut their costs everywhere they can.
Yeah, it's a tough environment when rates are down 20% and costs are up 20%, right?
That doesn't add up.
Right. Yeah.
Todd, one of the things you've been very good at articulating is the sort of the transition point between being leased on to being an independent contractor based on leased on owner operator rates. So your data suggests that to be an independent contractor, to run your own truck and trailer, absorb the inefficiencies of live loads, lumper fees, all the different things that go with it, you put that at about 0.48 cents per mile, so 48 cents a mile. So if we add that to say $1.70 a mile leased on, that would have rates at around $2.20 a mile, right? So we're about 18 cents, maybe 15 to 18 cents a mile off where that break-even point would be before being an independent becomes more viable. We expect spot rates to be up about 12% in the next year, but in the second half of next year. So I'm just sort of curious. I see it happening where we could see independent carriers become more in vogue in the second half of next year based on where we think spot rates are going to head.
I think you're right, Dean. It's kind of the great migration, and you just follow clumps of people with their own truck to watch what they do, and it tells you what the market does. And go back to 2022 and how many people got their own authority and went from company driver to being owner operator, then got their own authority. And then we had the reverse of that in 2022, 2023. They left the spot market, they went to carriers. And then ultimately, the carrier rate, contract rates went down in the end of 2023. And so, yeah, you're right. The market's got to turn, right? We do have to get to a break even. it's interesting because we still every day sign up drivers that have their own authority. They're running the spot market, and so they can make money, but it's a bit of a one-off, right? And so to see a mass shift from, I'm going to be hunkered down with a motor carrier to I'm going to go get my own authority and run the spot market because it's so lucrative. We've got a ways to go. This is the longest period of time before they've been incentivized to do that since the Great Recession, and it would make sense just if you follow trends that probably the back half of next year is when that will start to happen. So I agree with you, Dean.
Just on that subject, before I throw to Chad, one of the things we heard at DATCon, a lot more new authorities for, your 350 dually pickup and a 40-foot gooseneck, that hot shot combination. Have you seen a lot of that in your business?
We have in a lot of ways, right? The recreation market's been super robust. So those people can haul a couple camper trailers. They can haul cars from Colorado to Arizona right now when all the people are going south for the winter. And we have definitely, it's not really our niche, but to be honest, we are spending sales and marketing effort in that business because we've seen it grown. We have over the road drivers that are saying, yeah, I just bought my pickup and a trailer and I'm going to go haul some of that freight. And so, it's, almost like Uber and Lyft drivers. We've seen drivers migrate into that business, right? When trucking's no good, people find other things to do.
Yeah. I was on I-35 last week in Austin. As I always do, I go out and just sort of eyeball the interstates, and it felt like every second vehicle hauling freight was a hot shot. And that's probably more geographic specific because you see a lot of oil field activity out in the western part of Texas, sort of the southwestern part. So you always see those guys with a lot of drill pipe and casing and generators on, but it just seems like there's much more of it these days. And that has to be fitting into what shippers were doing, which was looking for, as they wound down their inventories, they were shipping more part loads. We were seeing that on our load boards, where you'd see a load come in with like a much more multi-stop, multi-pick loads, as opposed to one full load, because shippers just weren't shipping as much full loads. And I think that fits that hotshot narrative.
Are there lower barriers of entry into that space, less regulation, or is it the same?
No, there's a ton, right? Just from a cost perspective, typically those people don't have to log. It's for sure an easier space. Yeah. Typically lower paying, right? I don't know. I'm going to guess if a trucker owner operator is going to make $60,000 or $70,000, those kind of businesses are going to make, $45,000 to $55,000. So kind of depends where you're at. People that hit Social Security and got a little bit of income might want to go do that rather than hauling over the road. We see it in a bit of an older demographic typically, but also younger. Like I know people that got burned out on college that said, I'm going to go buy me a dually and haul some freight.
Interesting.
Yeah. Anything else, Chad?
Todd, I'm curious from your perspective, any advice for shippers as they're moving into this tighter market that they're looking out ahead over the next year? Anything you hear from your customers that shippers can do to prepare to make sure that they've got capacity in place and they're seen as a shipper of choice?
That's a great question, Chad. I'm fortunate because we deal with 20,000 independent truckers, but we also have partnerships with 300 of the largest trucking companies in the US. So I spend a lot of time with them. And the one thing that I would say, and I don't like this, but God, COVID just caused such upheaval. Like I know large carriers that were very fair during COVID. Sure, they all made plenty of money. It was a robust market opportunity. Trucks got moved to the spot market, but they typically met shipper commitments. And in a lot of cases, they didn't jack the rates to where they could have. And they feel like the last 2 years, really what I heard is the shipping management went from kind of the transportation manager to the CFO because transportation costs just got elevated a ton, right? And they became a bigger piece of every corporation's budget, and the board got in. So they just got hammered. Like it just turned into brutal negotiations. And so that's going to happen in return. Sadly, it has to, because truckers are not making money. And so the minute the market turns. So my advice would be pick your friends, align, remake friends, because the carriers don't have a lot of loyalty right now. They've been burned terribly. Sadly, it's just what the market caused. And so I would start aligning quicker, sooner rather than later, because there's a lot of data. You guys provide amazing data.
Yeah.
The carriers know when they're going to be able to take rate increases, and
Right.
they're going to be aggressive. They're not going to sit back and wait. So
Mm.
align quickly, and try and do some long-term stuff so we don't have this whipsaw we've had for the last 3 or 4 years.
Yeah, that makes a lot of sense.
It's great advice.
Yeah.
One last question. On the regulatory front, anything on the horizon? I think maybe the speed limiter debate is pushed back a little bit, but anything you're seeing that might be a tailwind or a headwind on the regulation front?
Gosh, Dean, there's a lot we could talk about, but if we just think about the election and what happened last time, my favorite thing is the independent contractor model is always under attack during a Democratic administration. Trump, reversed a pretty tough 8 years under Obama in his first few months in office. So I expect to see that attack subside. So independent truckers don't have to worry about that threat. Of course, the EPA stuff that is driving, some 2027 crazy increases in truck prices, maybe some of that subsides a little bit. Tax law is going to be huge. I mean, that's not necessarily regulatory, but all the Trump Tax Cuts and Jobs Act cuts were set to expire next year in 2025. And a lot of that's a big deal. I mean, there's a lot of money, not just for corporations, but for the independent trucker, the qualified business income deduction literally saves $3,000 to $6,000 in taxes a year, and that was going to go away likely next year. Trump will probably extend that. So a lot of things that are going to, I think, be tailwinds. They got to get put in place. But yeah, a lot of I think good stuff. If you guys remember, Trump's motto last time was, for every new regulation that gets put in, 2 must be taken out. And so expecting that the same thing will happen. Reduced regulation helps business for sure.
Yeah. It feels a lot like early 2018 did, when we had, pretty strong industrial economy, tax cuts. I think we had accelerated depreciation changed in the tax law, and the corporate tax rate changed. Am I correct?
Yeah, absolutely. So in a lot of ways, but the most simple is they allowed you to take accelerated depreciation on used equipment. So I could go buy a truck, write it off 100% in year one, which gives me a great tax break. And again, a lot of that stuff was set to go away next year, which will likely get extended. So it's going to incentivize buying, should be good for the used truck market and investment for sure.
Yeah. All good news. All right. Well, thank you. That sort of brings us towards the back end of the show here. We need to wrap up. We're almost at time. Todd, tell us how people can get in contact with you if they'd like to contact you after the show.
Yeah, sure, Dean. atbs.com is our website. You're welcome to go there. You can find us there. Phone number is 888-640-4829. Happy to talk to anybody about anything, and keep our truckers on the road, man.
Yeah, thank you. Love having you on. This week's Freightvine podcast, Professor Capitalist is talking to Tim Denoyer from ACT Research. I'll be on with Jimmy Mack on Radio Nemo this Thursday morning on Road Dog Radio Channel 146. Next week's show, Nicole Glenn from Canada Expedite is here talking about refrigerated logistics. With that, another show's in the books. Be safe, be nice to everyone. We'll see you back here next week at 10 a.m. Eastern, 7 a.m. Pacific.